Hi, I'm Mike Litton, and this is your market update. We've got new numbers for the month, January to January, from January of last year to January of this year to go over with you. And then we're going to talk a little bit about interest rates, talk a little bit about the market, that kind of thing, and what happened this last week, pardon me, with the CPI numbers, Consumer Price Index numbers. So let's start off with new listings. New listings were actually up 8.1%. Closed sales were up 0.4%, not much, but up a little bit, versus down 21.5. Median sales price is $837,263. This is countywide, San Diego County. Average sales price $1,096,599. Percentage of price received 98.4. It was 98.6 last week, or last month. So 98.6 would be on $1 million listing. The closing number would be 984,000 average. Housing affordability index down 13.2%. Months of supply were up 7.7% to 1.4 months, which is actually down if you remember from last time. This is the year-long, or probably the 50-year graph, and then this is the 1-year graph, and then this is what interest rates look like lately. So they've ticked up a little bit, partly because there was a sell-off on the stock market, or probably run up on the stock market. So money was moving out of bonds and into stocks. So we're at 7.09%, which means basically at a FHA VA rate, we're about 5.99%, with an APR of about 6.24. So weekly snapshot. So on the market, 2,852 versus 2,817 last week. That's up 1.24% week over week. Look at the new listings. 1,074 versus 799. It's up 34.3% in 1 week. New listings are up 34.3% or 34.4% in 1 week. Pendings are up 3.84% weekly. So if you remember, our pendings have been up consistently the last few weeks. So we're starting to see more homes sold, more homes getting into escrow. Pending, if you remember, is an offer accepted. They've opened escrow. So consumer sentiment, we talked about before, up big time last month, and that was a big driver, along with interest rates dropping. It was a big driver as far as buyer activity was concerned, and demand. The chances that the Fed's going to cut interest rates, let's talk about this for just a second. This consumer price index number that came out was a monster number. It was way, way higher than what the street was expecting. So we had a massive sell-off, and all of the percentages changed. If you remember, we were at 47% for a March rate cut. Now we're at 8.5. And by the way, this is handicapping. So this is what Wall Street experts are saying in a survey in terms of what they believe is going to happen. The May chances of a May cut are 36% versus they were 47% last time. And if you remember, June was 54%. Now it's 74%. So June flipped, right? So, and the averages are also starting to weigh heavier towards more rate cuts in the fourth quarter rather than the third quarter of this year. So we'll see what happens. It's not indicative of what's actually going to happen, but these are the chances basically. Well, let's talk about interest rates for just a second. Why is it so important? Why are we focused on it all the time? It's because affordability here is a big deal, and affordability drives our market. A few years ago on my radio show, we had Alan Nevin, one of the top economists in the nation, also a good friend of mine. And he basically told us that for every 1/4%, in San Diego County, the interest rates go up to the rate. Every 1/4%, there are over 23,000 San Diegans that cannot qualify to buy anymore. In fact, it's 23,900 and change. Okay. So if you can imagine, every point change, every point increase basically locks out or disqualifies upwards of 100,000 San Diegans from being able to buy. That's your buyer pool, right? So affordability is a big deal here. It's a bigger deal here than it is just about anywhere else in the country. The Bay Area is another place where it's a big deal, and the island of Manhattan in New York is where it's a big deal. The rest of the country, interest rates can ebb and flow and do their thing, and affordability is affected, but not affected as much because prices are not as high as they are here. The prices here are just astronomical compared to the rest of the world, the rest of the country, versus other than, of course, the Bay Area and Silicon Valley, San Francisco area, and New York, Manhattan. So that's why we talk about interest rates as much as we do. If you have questions about that, feel free to reach out. I'm happy to answer any questions that you have. Also, Fed, we talk about Fed long-term rates. or the Fed and long-term rates, talked about that last week. We had some feedback about it, and I was happy to answer those questions. Here's the thing. When the Fed moves interest rates, it moves two different sides of the rates. It moves the short-term interest rate, which is those chances, those percentages we were just talking about. That's where they affect the prime borrowing rate. They affect short-term interest rates are short-term. The federal funds rate basically affects the prime rate. It also affects credit cards, car loans, shorter-term type loans. When you're talking about 30-year or 15-year, 20-year, and 30-year fixed rates, that's a different side of the market. And they can affect that too by using that balance sheet that we talked about. That balance sheet sits at 7.7 trillion. At one point during COVID, it was 9 trillion, 9.9 trillion, almost $10 trillion. So what they do is they actively get involved. They're not right now, but they actively get involved in buying mortgage-backed securities and treasuries in order to artificially keep keep long-term interest rates down. So 15-year, 20-year, and 30-year fixed rates, they're trying to keep the yields down. So they're trying to drive the price up, trying to keep the yields down, and the interest rates, those long-term interest rates, follow those yields. So that's how the Fed affects the long-term interest rates and the short-term interest rates. So if you have questions about that, feel free to give me a call. Also, this is what the balance sheet looks like right now. That is COVID. That peak right there is COVID. That is where we are currently at 7.7 trillion. Remember we talked about solution-based, so you can do VA, no down, no closing costs. You can also do an FHA with no money out of your own pocket. If you have questions about that, feel free to reach out and give me a call. We talked about the Fannie Mae thing before and what a big deal it is. A lot of people are buying units using this type of financing now. And then the podcast, let's talk about that for just a second. I want to thank you from the bottom of my heart for all of your support. We're getting ready tonight. We'll exceed 70,000 listens, 40,000 downloads. These are monster numbers, and I cannot thank you enough. We're now in 27 countries. We've added 3 countries in the last week. Cannot thank you enough for the amazing success this has been. Last week, or week before last, we had over 200 requests to be on our podcast in 1 week. Just saying it just freaks me out. So we're adding people. We're going to do 50 plus interviews this month alone. And in four and a half months, we had done 100 episodes. So really crazy. So you can follow us. You can go to our YouTube channel. If you look up Mike Litton Experience, that's what the YouTube channel's named now too. It's at Mike Litton 3375. You can follow us on Twitter, Instagram, TikTok, Facebook at Litton Realty. If you want to meet with me, go to calendly.com /REO760. And you can book a time to talk with me. No cost, no obligation, no pressure, no nothing. We're just going to answer any questions that you have, and there absolutely is no question that you cannot ask. I hope you have an amazing week, and we'll see you next week. Take care.